Good afternoon or good evening to all my friends, family, students, loved ones. Today, I welcome you back to my channel. My name is Dr. Bisayo Tokiti, and I will also be taking us today through another series of the enterprise management classes. Like, if you can remember last week, I uploaded the course structure for this semester and some of the courses I'll be taking through the course of this semester. One of them is enterprise management cases, or enterprise management and cases 409. And we'll be looking at the course structure week in, week out, one per week or two per week, depending on how our time permits to do this video. So I say a big shout out to all my subscribers. I'm grateful, and I'm also hoping that you share, you like, you comment in the comment section below, and you subscribe to my channel. And I promise it's going to be educative and value adding. Boom into what we have today. Today we'll be looking at sources of capital or financing for either a new business or an existing business. And like everybody knows that finance is key to starting up any new business. And everybody also know that blood is important to our bloodstream, the same way finance is important to running any business, whether to start up or for the day-to-day transaction of that business, or for keep up for the business to run smoothly. Finance is important, and money is needed to run any business enterprise, whether new or already existing business. For this class, we'll just be looking at three sources of finance three sources of raising capital for your business. Like I said, it can be a new business, it can be an existing business that you want to upscale, depending on what you are looking at. But this is all applicable to all kind of business that we are looking at. So what are the major sources of capital, of financing for our business? The first one is called debt financing. The second one is called equity financing, and the third one is called internal financing. We have debt financing, we have equity financing, and we have internal financing. We'll be looking at what each of these sources means. These are just the major. There are other ones that are not listed. You can read up to know other ones that are not listed, but from my own research and finding, I found out three major ones: debt financing, equity financing, and internal fund. What do we mean? What do we mean by debt financing? Debt financing, from the word debt, it means you have loaned this money and you have to return it back. You have collected from someone, whichever the name it is called. So far that you are returning, or you have to pay back, or there is a repayment plan, it is called debt financing. Then equity financing, from the word equity, it means I'm giving you this money to have a stake in your business, or I'm giving you this money to be part of your business. I'm giving you this money to have rights, equal rights, or it depends on the agreement that you have made. Then the third one is called internal funds. That is the profit you have made within the business, maybe in the last, especially when it's an already existing business, in the last few months or year, you reinvest it into the business. Then you can also get new partners. You can sell your assets that are not as valuable as it ought to. Those are the ways in which you can raise funds or generate capital for your business. Then we would now look at all these sources one after the other. Like I said, we'll take the first one, which is debt financing. I've seen some other textbooks say debt financing is also internal financing, but not in all cases. But for my own findings, I will only call it debt financing. And like I said, debt is in Yoruba money. They say this in Yoruba. A debt is a once you borrow money. I can't remember that adage, but I shall know that once you borrow is a debt. So debt is still borrowing. You can use the word loan. You can say you are getting money from someone and you are paying back, depending on when. It does not depend on when you are paying back. Once you are getting the money and you have to pay back, is a debt. And what are the means in which we can get debt capital or debt financing. The first one is commercial bank. The second one is trade credit. The third one is called bills of exchange or promissory notes. The fourth one is called insurance company or shipping finance. Insurance company, shipping finance. We have hire purchase, we have equipment suppliers, we have savings and loans, we have credit union, and like that. Then sometimes private equity can also be added to it depending on the parts at which you are looking at it from. Then for commercial banks, everybody, you should know that who are commercial banks. They are established financial institution that are into anything that has to do with finance. They can borrow, you can save, you can fix. There are many things they do in the banking sector, and that is why we call them commercial activities. They are there to make money, they are there to make profit. And getting a loan from such bank, the first thing they will require of you is for you to have these 5 C's of credit. And the first one is character, capacity to pay back. What's your character? What's the capacity to pay back? What is the collateral security? What are the conditions attached? What is the capital? And like that. And when we talk about character, it means individual attributes, your passion, your integrity. They want to know, have you defaulted any loan before? Have you taken loan from any other bank or from any other person and you were not able to pay back? They want to see integrity in you. They want to see your experience. They want to also see your staying power. They want to see some other attributes. Can you actually pay this money back, or you just want to get and not be able to pay back? Then your capacity too. It means, can that business survive? Can it stand the test of time? Will somebody actually purchase that product or services that you are trying to sell to the market? Can this business be sustained? That is capacity, because it is when it's sustained that you have the capacity to pay back. Can the business produce or product serve economic value, or can this business make money? Can you actually pay back this money you are borrowing with interest? Don't forget that each time you go to such banks, you have to pay back with interest. So the first one I said is character. They want to know your integrity, your experience, your passion, your individual attributes. Then capacity. Is your business sustainable? Can it pay back the money you are requesting? Then also the third one is capital. What level of paid in capital are you contributing? Like, let's say for example, you need 10 million naira. How much have you gotten from the 10 million? Or you just want all the 10 million from the bank? Or let's even say it's 1 million naira. And from the 1 million naira, you don't say, you don't have a single kobo. You don't have 100,000 or 500,000 or 200 or 50,000, and you're getting some. You just went to the bank and said you need 1 million naira. The bank should come and give you the bank. Is the capital being used in the business? And like that, they want to also know some of those other things. Then the fourth one is condition. It means, what is your form of ownership? What is your location? What is the loan payment plan or the loan purpose? What is your potential growth in the market or market share? Who are your competitors? And like that. Then the last one is condition. And like I said, condition, it was condition I mentioned earlier. I've said character, capacity, capital, condition. It means one. What's the last one? Sorry, I'm trying to get the last one. Character, capital, capacity, capital, condition, and collateral. The last one is collateral. Collateral means, are you able to pay back the money you are requesting? No, it's not that are you able to pay back the money you are requesting. What are you putting to stand in case you don't pay back this money? Oniduro or iduro, what do you want to use to stand as a surety or something that is equivalent, that if I don't make up with this repayment plan, then you can take this off for me. Then I also said condition. The bank condition in banker's perspective means the economic situation, the industry in which you belong, the interest rates, your business experience, your individual experience, inflation rates, demand for money, risk, and many other like that. The first one we have considered is commercial bank, and we have tried to look at the 5 C's of getting a loan from the commercial bank. And we said the first one is character, the second one is capital, the third one is capacity, the fourth one is condition, and the last one is collateral. Then another one ways we can get debt financing is trade credit. And trade credit means buying stock or inventory on credit. Trade credit, you are buying everything you need on credit, and after selling or within a period of time you pay back the money. Most times the seller are credit worthy, and the entrepreneur just trust them and giving them minimum stock to test if they are actually credit worthy or not. Then another one is bill of exchange or promising note, and this is undertaking to pay the debt with interest at a later date. Like with bill of exchange or promising note, you have collected, let's say a particular product or services, and you are willing to pay in a later date with interest, or a later day with interest. Another one is have I said hire purchase? Another one is the shippers finance, where some financial institution specializing in financing the movement of your goods, or paying that money on your behalf until you are able to pay back, and definitely it also comes with interest. Then hire purchase is taking possession of an item and paying in deposit plus installment. You pay deposit plus installment. Ownership passes upon full payment. It means you are taking you have access to the product or services or the commodity you want to buy, and you are paying deposits of that thing you are buying. Then you also pay the balance instrumentally over a period of time. Once you pay in full, then you take full ownership of maybe the equipment, the property, the machinery, or whatever we are talking about, or whatever is involved in it. Another one is called business alliance, where you form cooperative, and from such cooperative you get loan to finance your business. Cooperative is one of the best forms of debt financing, that the interest rate is not as high as that of the commercial bank. For my own cooperative is about 5.5%. We have some other cooperative that they even charge 0% rate, interest rates, and many others like that. Then the second one we'll be looking at is called equity financing. The first one we looked at is debt financing. Then the second one we'll be looking at is called equity financing. And what do we mean by equity financing? Financing means that you are exchanging a portion of the ownership of your business for a financial investment in the business. Equity, equality. You are exchanging a portion of the ownership of your business for a financial investment in that business, or you are exchanging a stake for a financial investment in your business. Equity involves a permanent investment in a company and not repaid by the company at a later date. Then equity is also a formally created business entity. An equity stake in a business can be in form of membership units, or a case of limited liability company, or in the form of common or preferred stock as in a corporation. What are the sources of equity financing? We have bootstrapping, we have personal savings, we have loans from friends and family, we have angels, investors, we have corporation, we have venture capitalists, then we also have going public. Then what do we mean by bootstrapping? Bootstrapping is a means of generating internal revenue from things that seems irrelevant, generating your revenue, or creativity or creatively starting up your enterprise without necessarily have to borrow, or without necessarily have to go to the bank. We said it is highly creative acquisition and use of resources without raising capital from traditional sources or borrowing money from the bank. There is a high relevance on internally generated retained earning, and the benefit is enormous. You cannot overemphasize the benefit of bootstrapping. Then also personal savings. It means the money you have saved over a period of time and you are investing it into your business. Personal saving could also mean retirement fund, money you got from your real estate, cash, insurance policy, and many others like that. Then friends and family, you are getting money from friends and family to have an equal right in your business or to have a stake in your business. Then friends and family also consider some of these conditions. They consider the impact of the investment. Is this investment worth it or not? They also keep it strictly business. They don't want you to say, because I'm your brother, I'm giving you 1 million, you won't return it. No, you become partners. We are investing into this business together. Then sometimes they put it in a contract, in a written document, laws and policy that governs that business or that finance, and many other like that. Then another important one is called angels or angel investors. They are wealthy individuals that invest in, most times, technologically startup businesses or technological startup businesses, and they usually expect between 70 to 60 to 70% rate on return, or rate on their investment. Then also another thing that is peculiar about angel investors is that their exit strategy is of key importance. I take again that they are successful business people who invest their money in startup businesses, and most times the business lasts between 5 to 7 years, depending on how the rate on investment is coming, or the rate of return is coming in. Then the last one would also be considering are called venture capitalists. Who are venture capitalists? Venture capitalists are financial intermediaries, and that use other people's money and invest directly in portfolio companies. Most venture capitalists are organizations that they have gotten their money from either endowment trust or educational trust fund or insurance company or pension houses, and they are using such money to invest in technology startup businesses. Another important thing for the venture capitalists is that at the time of entry, they also know the time of exit. They also have an exit strategy like the angel investors, and they can exit the business through different means, whether by sales of IPO, or by management buyout, or by strategic acquisition. It could be by any means. Venture capital also refers to financing that comes from company or individual in business of investing in young privately held business. That I take again. Like I said, they are intermediaries between the owners of the money and the people who wants to use the money. Their role is supervisory, their role is management, their role is advisory, their role is to not to allow the money of those people that they are investing, or those organizations that they are investing into other startup business, not to go down the drain. Another question you might ask me is that, okay, once they invest this money, am I saying that all venture capitalist businesses are successful? No. Although they have, I can't say if they have equal failure and success rate, but there are lots of venture capitalist business that has been successful over the years. And because maybe we don't hear of the failures, we don't know that there are also a full of them that has not been successful, that has not come into the limelight. As we go on, or in another course, we look at some of the structures of venture capitalists, or some of the examples of businesses that venture capitalists have invested that have been successful in the world, that is also very useful, or that we use in Nigeria. Then we also look at some of those ventures that have also failed. They also invest into businesses within a period of 10 years, and maybe in 5 years, depending on how much they have made, if they have made their return on investment back, maybe between 5 years to 10 years, they are already planning their exit strategy. So I take a quick recap of what I said earlier, and the last one is internal fund, that is reinvesting of the profit that you have made over the years back into the business, or sales of assets, or new forms of partnership comes into the business. Like I said, we are looking at major sources of finance for your existing or a startup businesses, and basically there are three. We have debt financing, we have equity financing, then we have internal financing. I'll be expecting your question in the comment section below. Don't forget to share, to like, to subscribe, and to watch this video. I'll see you in the next series of enterprise management cases. Thank you, and God bless you.